This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Eric Stegemann, managing partner at TRIBUS Capital. TRIBUS Capital provides advisory services and investment in early stage PropTech companies. The fund looks to leverage the network effect of the TRIBUS portfolio, which has relationships with nearly 100,000 realtors across the USA and Canada. Eric, thank you for joining us.
Thanks for having me, Hall. I'm excited to be here.
Great. So tell us more about your background. What did you do before you started investing?
So I actually started selling real estate to pay to go to college. I don't imagine I would be doing this till 20-something years later. And kind of got stuck in this industry. I figured, okay, well, what's a job I can do in college? I went to Northwestern University in Chicago, and back 20-something years ago, it was even then $45,000 a year to go there. Mom and dad didn't have $45,000 to pay, and I didn't want to leave college with a whole bunch of student debt. So I said, hey, what's something I can do in my off hours, on weekends, things like that, when I'm not studying or writing papers or things like along those lines. And I found real estate. A buddy of mine said, hey, I found this real estate thing. Do you want to try to do this? I said, sure, why not? If nothing else, I'll learn something. And got into it, started selling real estate after hours, and made about 4 times in my first year of what I was going to make with an engineering degree 20-something years ago. So got into the business and fell in love with it, fell in love with the fact that it rewards people who hustle and work hard, and did pretty well with that. Then started my own brokerage. We grew it to be the largest independent real estate brokerage in St. Louis, Missouri, which is where I'm originally from, and sold that, but kept the tech. And then we started 12 years ago, TRIBUS, which is a software company focused on medium and large size real estate brokerages. And then spun out from that, we started making investments in early stage other prop tech companies, real estate technology companies, and have had some high profile exits, including one company we sold to Zillow after only about 7 months in existence. So, that's gone really well. So my day to day is, half running the real estate brokerage software division, and then half doing investments and advising our entrepreneurs and our portfolio companies.
Great. So what excites you right now?
Well, the real estate technology space is just absolutely on fire. I actually gave a presentation to 72 of the largest brokerages in the country 2 days ago. And in that presentation, I happened to pull up some figures on investment in the space. And so in 2016, in all of prop tech companies, there was only about $7 billion invested. And in 2019, it was over $30 billion. So just in the course of about 3 years, you're talking a X increase in the amount of investment in the space. You've had companies like Compass on the brokerage side, tech-enabled brokerages that have come out. You've had companies like Open Door raise billions of dollars that are focused on iBuying, which I'm sure we'll probably talk a little bit more about later on. And then just general real estate technology companies that are out there. It seems like the investment world kind of forgot about the space for a long time, or certainly had blinders onto the space for a long time. And then suddenly between probably in about 2017, 2018, it was, oh, wait a minute. This is the largest capital in the country is actually in people's homes. And maybe we should take a look at this space. And so everything inside of the space right now is really exciting. There's been more change in the space in the past 3 years than probably in the previous 30 years combined. And so everything in the space is pretty exciting these days.
Great. Well, you see a lot of startups in the prop tech sector and a lot of investors. What's your advice for people investing in startups in this space? What do you tell them to do before they write that check?
Well, I have a saying. So we get calls all the time to us to invest, for us to invest at Tribus Capital, to invest in companies. And I always tell the entrepreneurs the first call is free, and happy to chat with them and give them some advice. And so any other investor that's out there, I would say to really learn the space. And if you don't have a competency in the real estate space at all, and you think you know enough just because you've bought and sold some homes before, I would say step back for a minute. There's been a number of private equity firms that have lost their rears over the past few years investing in this space, thinking, oh, we're going to change this, or we're going to change that, or MLSs aren't needed anymore, or hey, we can just go get all the real estate data and do some new big thing with it, or oh, we're going to disintermediate realtors overnight, and nobody's going to need them anymore if they just follow, this new tech thing that we're going to roll out. And in every one of those circumstances, you've seen them just lose millions of dollars. In fact, a very well-funded company resorted last year to just suing everybody. And I think most investors would agree, if your business philosophy is sue everybody, you're probably not in a good spot. And that company actually had to lay off, I think it was like half the staff late last week sometime because of the problems they were going through. So my advice to an investor in the space is simply just do your homework. And if you don't if you haven't spoken with realtors, spoken with MLS software people, spoken with owners of brokerages, spoken with people that have gone through the space and had good and bad exits, then you probably don't know the space, and I'd highly advise you to not invest in the space, because it is fraught with landmines.
Great. Then on the other side of that table, what's your advice for people running startups in this sector? What do you tell the founder to do before they go out to raise funding?
It's not make sure your game plan is solid. It's not nearly as easy of a space to enter as you think it is. I said the thing about the first call free. And so I'd probably take on average, maybe 5 to 8 calls a month from entrepreneurs that say, oh, well, you've had exits, you've done this, you've done that. Would you invest in our company? And I say, let's get on a call and learn a little bit more first. On that phone call of what your experience is. And I think the number one mistake that I see entrepreneurs that are starting up inside of real estate or real estate technology companies is their assumption is that the data is free. Because in a lot of other industries, data is more or less free, or you can legally scrape data. And a big thing that we see with prop tech companies is their assumption is, oh, well, we can just get the data from Zillow, or we can get the data from Realtor.com or something like that. It's just not how it works in the industry. There's copyright problems. There are 625 plus MLSs in the United States alone. That's not even counting Canada. 625 MLSs in the United States. You have to go to each one of them independently of each other and get approval. They can unilaterally decide, hey, we don't like you, Eric, and we're going to not give you access to the data. And there's pretty much nothing you can do about that. So just make sure your I's are dotted, T's are crossed, and that you've budgeted in the multi-million dollars a year that it takes to go out and get the real estate data before you go to the next step of whatever your business model is. So that's, if I could tell everybody listening, if I could just have them check into that before I take the first call, I would save 8 hours a month of talking to entrepreneurs, and probably 9 out of 10 of them realizing that their model isn't going to work if they can't get the data for free.
Great. Well, that's good advice. So you talked a little bit about the current landscape there, but can you dive into a little bit further about the state of investing in this industry and how do you think the industry is evolving?
Investment, I think what's happened over the past few years is a lot of private equity firms, venture firms have used the shotgun approach, which in a lot of places in investing, and particularly in a B2C businesses, and a lot of what happened in Silicon Valley, shotgun approach is a fairly effective model if you have the capital to do it, because you invest, a few $1 million here, a few $1 million there, a few $1 million here, a few $1 million there. And one of them hits big. And, out of the 25 million that you invested in 5 companies, one of them hits, and, your payback isn't 25 million, it's 250 million or more, right? The problem in the real estate space is that there's lots of room for $5 and $10 million companies, which isn't exciting for the majority of venture investors that are out there or private equity firms that are out there. There's very small space in real estate and real estate technology for the multi-$100 million companies. And so from that perspective, I think what you're seeing now is some folks that got in that what they thought was a gold rush in 2019 are finding out that it may not have been as exciting or as quick money as what they were expecting it to be. And you're starting to see dispositions where a private equity company is selling off their stake for pennies on the dollar to a different private equity company that's going to go in and take over that organization and more or less just collect on the revenues and the contracts that are there. There's a number of firms in real estate technology that's their focus is. We have a joke about a couple of them. It's like where companies go to die, meaning that the founder, realizes that the upside potential isn't as big as what they expected. The TAM isn't as big as of what they expected. The private equity or the venture investors realize that it's not as a quick win as what they were expecting, and so they're willing to just cut their losses and move on. And there are companies out there that are in this space that absolutely just specialize in this and will go out and buy any of these companies for essentially 2 or 3 times revenue, and just collect on it for a couple of years and rake their money back. And then anybody that sticks around after that, great, they're making profits on it. But it's not going to be a company that receives a lot of investment or a push on their technology going forward. So we're starting to see those come around that some firms are realizing the mistakes. And anytime there's a down, a disposition or a down round or something like that, I think it's made a lot of other investors in the space wake up and say, hey, it's not as easy money as what it happens to be. On the converse side of that, from the actual real estate side, I think what you're seeing is the average brokerage is waking up to alternative modeling, not necessarily in terms of commissions per se, but in terms of companies like Open Door do have some value. I think a lot of brokerages 10 years ago or 6 years ago, when Open Door really started to have their rise, they would say, oh, well, yeah, you could sell to Open Door, but it's no different than selling to, Paul, do you remember Homevestors and Ugg Buys Ugly Houses?
Yes, remember those guys.
Yeah, so I mean, they're still around. They were essentially the very first iBuyer that existed in any kind of large capacity, but they would offer 60 cents on the dollar, more or less, for properties. And I think Open Door, when it first started, when you actually got down to it at the end of the day, that's kind of the ballpark that they were in 6, 7, 8 years ago. But today we're in a totally different ballpark. Open Door and Zillow Offers, which is their iBuyer program, they're offering at or above competitive market rates for properties just to get inventory and to have deal flow come through them. And in fact, there's some talk in the space about Zillow and their stock price is now trading based upon those properties, even though they may lose money on each individual property and may not be profitable. The sheer fact of revenue growth is increasing, or was increasing at least for a while, Zillow's stock price. So it made sense for them to take more or less any deal that came along, as long as they were losing within a certain range. But I think brokers are starting to see that and recognize, okay, well, it's no longer the Homevestors, Ugg Buys Ugly Houses. It's, this is a real opportunity to help our sellers and get them top dollar for their pricing. And then, then the agent can help them on the buying side of the transaction. So that's the kind of the two big things that I'm seeing.
Right. And so let's talk about your investment thesis. You talked about investing in prop tech deals and you have a certain thesis and criteria. Tell us more about that.
We really focus on the very, very early stage. In some cases, even just an idea stage company is where we look at. And the reason why is, if you go back to what I said just a couple seconds ago there about there's lots of room for the $5 and $10 million companies. There's not a lot of room for the $100+ million companies. We're really looking for the entrepreneurs and to advise them early on to get in, to give them, seed stage capital to get the idea off the ground, to do a run, to actually try to sell it to agents, sell it to brokers, for us to put it through and follow our network effects inside of TRIBUS, with working with about 1 out of 10 realtors in the United States use one product or another of ours. And so in that, we want to connect with them very early on. We want to be their primary and in most cases their only investor. And we're looking for them to we want that the single or the team of entrepreneurs, the founders of the company, we want them to retain a 50 plus or more % ownership, because then growing it to a $10 million company, if they can do that in 2 or 3 years, they're walking away with $5 million perhaps, and it's a quick win. They're getting quick wins, and I think, outside of venture capital and Silicon Valley venture capital and everything like that, if you asked an average person on the street, if you had a really good idea, and if in 2 years from now you could execute on that idea, turn it into a $5 or $10 million company where you're walking away with five, half of that, would you take that opportunity? And I think most people would say yes all day, every day, to that they could make, essentially $2.5 million a year with coming up with these ideas and executing on the ideas. And that's what I say. There's lots of room in this space for the $5 and $10 million company. There's just not a lot of room for the $100 million company. So by finding them early, by talking to them in that idea stage or very early stage, we can be their primary investor and kind of guide them to this position of, don't think of it as I'm going to build a $100 million company and it's going to take me 10 years to build it. Think of it as I'm going to build a 2-year company and I'm going to get it to $5 million and be able to sell it off as a feature into some other larger organization that can write me a check for $10 million, no problem. So that's really what we look for. We have some other companies that we have invested in that have grown larger than that. But those types of companies, we found we can't provide nearly as much value for advisory and for the network effect of being able to present them and say, hey, look, what if I could grow, you're at an idea stage. What if we go and present this to our clients and we take you from 0 MRR to 50,000 MRR in your first 60 days, right? A lot of entrepreneurs would love that. Because then obviously they can take that cash and just start investing it and bringing on more team members and growing faster. And that's what we focus on, is where we provide that extra value beyond just writing a check.
Great. Can you talk about one or two startups that fit that thesis and maybe portfolio companies?
Sure. So a company that we invested in back in 2013, it's actually what started TRIBUS Capital, is we had somebody come up to me personally at an event and said, hey, look, we've got this really good idea and we want to execute on it. And we have this idea because we've been working on MLS data for the past couple of years. And we think we have a pretty good idea. Can we talk through it with you? And I said, sure. Let's sit down. We chatted through everything. And in the process of going through that, what we realized is that their idea was a diamond that needed some slight refinement. And we refined it and everything like that, brought it out with an idea to the market, had a working demo, but still needed some more work on it. And within 7 months, Zillow liked the idea so much of where we were going and trying. And the concept was to normalize all MLS data through a single feed, where any other prop tech company could go to a single feed and get all of the MLS data from that single feed. All the data normalized. We have 625 feeds that have to be normalized these days. But that company was called Retzley, and TRIBUS was the primary investor early on. And the company was in existence from the date that the first kind of demo product worked till the date of acquisition was just under 8 months. 7.5 months or so. And I'm not allowed to disclose how much it sold for, but it was a good chunk of change. The founders were incredibly happy with what happened in 7 months. It's a perfect example of my investment thesis of, it doesn't have to be a $100 million company. I think any entrepreneur that would be out there would have been happy with what they walked away with in 7 months worth of work. And that was a good one. So Retzley was one of our great exits where we can talk about the exit, not necessarily how much it sold for. We have another company that we have a portfolio company right now called MapTrack. MapTrack is a really interesting company. it actually uses data from your browser, uses data from your computer, your IP address. And there's other companies that do something similar, but not to the extent of what these folks do. There was a company called, I think it's Toro or eToro, based out of Nashville, and they have IP addresses to tell you who they think the person on your website is. But what MapTrack does is it maybe has a lower match rate than what the IP-based matching is, but it's right over 99% of the time, whereas those IP-based matching services have a higher match rate, but they're inaccurate pretty often because obviously your home IP address changes. Most people don't even know when it happens, but usually it's once a month, if not more often than that. So it tells you that. So imagine for a realtor that's out there to be able to know who's on their website or what the addresses of folks on their website happen to be, or a mortgage company that says, hey, look, who filled out to get mortgage rates on our website without them filling out a form. We know who that person happens to be. And about 30% of the time that this company can tell you that information. They work with magazines, car dealers now as well, where it's you go to a car dealership website. If you've ever gotten one of those postcards that says, hey, Hall, we're looking to buy your 2017 Lexus, a car, a 2016, 2017, 2018 Lexus, whatever model it happens to be. If you have one of these vehicles, call us. Well, there's a good chance that might be MapTrack software because we, in pulling that data and that 30%, not only know the address, but we know all the makes and models of the cars registered at that house. So a dealer can go and do that and pull that data. So that's a really slick company and a couple good examples there for you.
Great. Well, we heard about the challenges in the space during the advice portion. Can you dive into that a little bit further and tell us what is the challenge a startup faces in launching a business in the PropTech sector?
So data is not free. That's probably the biggest thing is everybody thinks they can just go get the data for free and all the MLS data and all the sold data. But there are 625 MLSs in the United States. Each one of them owns the copyright to that data. So you have to go and make arrangements with each individual MLS. So you can't just go say, I'm going to turn my product on nationally overnight. You have to go to each MLS where they work and to go and get that data independently from each one. And there may be illegal scrapers that are out there that are stealing the data that you might go find in a short term to get some data up and running that are out there. But in most cases, those are found pretty quickly. And you never want to build your entire foundation of your business on stolen, anything stolen, right? So that's certainly a big one. Also, the other big thing that I see as challenges in the space too is, there's that old saying, the riches are in the niches. And a lot of people say, oh, well, there's, a niche here of real estate and there's 1.5 million realtors with another million people on top of that just have a real estate license, but aren't necessarily realtors. And so you get to this world where 1 in every 150 people in the United States or 1 in every 100 people in the United States has a real estate license. And you say, okay, well, 1 in every 100 people is essentially my addressable market. The problem is connecting with those people and the churn rates that companies tend to find in connecting with those individual agents. Often, like for example, CRM. I've seen tons of companies come out and offer CRM for realtors and say, oh, we're going to make the next CRM. And what's happened is it's been a race to zero in terms of what these companies can charge for their CRM product, because so many of them have come out to try to connect with this niche that's out there. And so it's a race to zero. More importantly than that is agents can be fickle with their technology decision-making purposes. So they could sign up for your CRM this month. During your free trial, they could turn on for a couple of months and your data shows, well, if I keep them for 3 months, then they'll probably stick around. The problem is that modeling doesn't always work that great because there's so many outside factors that you can't control in terms of getting them to sign up. Tech companies often think of them more like a B2C because there's so many of them and they have the direct relationship with the realtor. But the truth is it's not really a B2C and it's not even a B2B because the other thing that can happen is their broker comes out and says, hey, look, I've purchased you a great CRM and everybody's going to get it free. Well, now all the people that use that CRM they were paying for directly say, I don't need you anymore, right? And you could lose 1,000 clients, 2,000, 5,000 clients or paying customers. You could lose them essentially overnight. So there are a lot of landmines in the space, and that goes back to my advice. If you're a founder, which is find an advisor, find investors that know the space really well, whether that's, calling us or whether that's any of the other investors that are in the space. Just find those, because they'll be able to present you and look at your modeling and say, wait a minute, you've got a 3% churn rate for selling something direct to agents. Your churn rate might be 30%, a 10-time churn rate because of what can happen in this space.
Well, we're at the top of the stock market right now. It's very frothy, lots of money available. But so what are the challenges in this space for the investor?
Of course, we've had a run up in real estate prices, and nobody really knows what's going to happen over the next year or two with those real estate prices. My take is that we're going to see a plateau, not necessarily a bubble. I don't think that we're in a bubble, particularly because during 2008, so much percentage of the home ownership that was out there, nobody had any money down. So it was easy to walk away from everything. Now, almost 30% of transactions in the United States are cash transactions, number one. Number two is the ones that aren't cash transactions, the average down payment amount, is through the roof because of lending requirements lately. So I don't think we're going to see a huge foreclosure crisis, but it certainly could be that less homes transact, or that they transact and don't have as much of a run up. Certainly as being an iBuyer investor like Opendoor, Zillow, I would be very, very watching my P's and Q's here because you don't want to be stuck with a whole bunch of inventory that's stagnant in terms of pricing when you've been paying top market pricing for all of that inventory. So as an investor, both just from a tech standpoint or an iBuyer standpoint, or even just a general real estate investor that might be out there listening to your podcast here, just invest with a longer term thesis here, so that if there is a stagnation period that we end up with, or a plateau period that we end up with, that you're not relying on the fact the home's going to appreciate 30% next year like it did maybe last year. So that's kind of that side of it. The other side of it is, for the investors, I kind of mentioned this a little bit already, is if you don't know the space and you're trying to invest in the real estate, particularly in the real estate technology space or the real estate brokerage space, just get somebody who's been in the world for 10 plus years. Ask them all sorts of questions. Let them try to find holes in your investment thesis. Because there are so many landmines in the space that you may not know of, that every I you think is dotted and T is crossed, and you get everything lined up, and you invest in a company and they're doing great things and they think they know everything about the space, and then they get something out there and realize that the whole model falls apart. I've seen that happen to multiple companies.
Right. And so you see a lot of different sectors and applications inside the prop tech space. If you had to pick one or two that are good opportunities for investors to pursue today, what would you call out?
I think anything in the particularly in the tech space. I would have been an investor in the iBuyer space 2 years ago. In fact, we actually did try to set up an iBuyer program that would go inside of the brokerage and work inside of brokerages. We had a couple folks working on it with trying to go get outside investment, but the problem is you need literally billions of dollars of outside investment to be able to do one of those correctly. And the money seemed to have already been flowing that was out there from BlackRock and those other companies that were interested in owning the properties or certainly investing in real estate. The money was all flowing into, Zillow offers, or flowing particularly into Opendoor. So a couple of years ago, I would have been we were attempting to be an investor inside of that space. Today, I think the safe space is in mortgage technology, real estate technology. I think, when it comes down to it, and the folks that are listening in right now that are mortgage brokers or mortgage bankers, sorry, but everybody has wanted to talk about the disintermediation of the realtor, and I just don't see that as inevitable at all, because I think you need somebody that's a trusted advisor to go to ask questions about, hey, what does this mean on the inspection report, or what does this mean about the county rule or the HOA rule or whatever. You need that person with that local domain experience in that market or in that neighborhood even, and it's just hard to replace. And on the flip side of the coin is mortgage, and I just don't think there is enough to prevent the same thing, or prevent disintermediation from the mortgage side. It is the same product, essentially mortgage to mortgage to mortgage. It's just which product you go with. And there are companies out there that are working on these sorts of problems. I mean, Rocket Mortgage is focused on this kind of an idea, but I think there's plenty of room still left in the space. Better Mortgage, a number of people I know had invested early on in Better Mortgage, has just tried to digitize the entire space, where you don't have to talk to a mortgage broker and everything like that. And there is still room, I think, in that space to make the average person be able to completely obtain a mortgage, do everything needed to obtain a mortgage completely digitally. Paul, I'm sure you've heard of Plaid before, right?
Yeah.
Okay, great company. I think Visa tried to buy it, and then there was some question of the antitrust side of things, and that got called off. But phenomenal company, and I think there's so much area there for Plaid to for a mortgage technology company to come in and just connect up to Plaid. And think about it, I just put in my banking information, I put in my stock account information, I put in all of that, and you can pretty easily these days pull that information, come up with aggregate data based upon it. You can also use that same aggregate data to come up with credit rating for a person that maybe doesn't even need to use FICO, but certainly takes into account ability to pay and likelihood to pay, just from connecting up a Plaid to a system and say, yep, Paul, you know what? Great, you're approved for up to this much money, and you can go out there and here's your approval. And then, by the way, whenever you're ready, just go to this portal, put in your contract. Our OCR system will grab the data from the contract, and we can process your mortgage essentially entirely digitally. I think there still is room in that space. And I don't think there's a clear winner. I think Rocket's tried to pretend like they're a clear winner, but I think if you go through the experience with them, there's been plenty of issues, and you still have to have a human regularly involved. And I think there's room in the space to get all of that out of there. And the little known secret of the prop tech space is the money's all in the mortgage. So the average real estate brokerage makes 3% profit. So very low profit margin, and that's in a good year. They're making 3% profit. The money's all in the mortgage side of the business, anyways. And so even if you could offer great rates and completely digitize the process, I think there's a lot of money to be made there. Same thing in insurance, by the way, for that matter, is it's great to have somebody to call if something goes wrong with your insurance, and I think that will always be important. But signing somebody up for insurance or binding the coverage when they buy a new home, particularly, or buy a new car, I think there's a lot of opportunity in that space too.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
The real estate industry is an interesting animal, and I know I've mentioned this a couple of times, but there's so much, and realtors are, I would just say, are hardworking people. They're not this for investors out there that may have read Freakonomics or any of these books that are out there. If you're not familiar with the space, realtors are very hardworking people. They know, they have this extra bit of knowledge that the average, first of all, the computer probably can't ever have, to the level of knowing about HOA rules and knowing what will and what won't fly when things are subjective, particularly. They also know, hey, for example, in a particular market, when I sold homes in St. Louis, if you had a home built between a few different years, there was a good chance it had a circuit breaker box made by a company called Federal Pacific. And if you had a Federal Pacific box, they're known for fires. So the realtor walks in, and the first thing they see in there is a Federal Pacific box, and they say, hey, look, if you do buy this house, great, but just make sure you get the circuit breaker box changed out before you take ownership of it. Those are things that become very difficult for a computer system to be able to take out of the process. But you have to remember, it's people's biggest biggest investments probably of their lives for the average human that's out there. Their stock portfolio isn't their number one investment. It's their home. And people want that hand-holding process and somebody to feel good about and somebody to call if something's not right or if there's a question. Just like, if you talk, growing up, my best friend, her dad was the COO of Edward Jones. And, early punk kid me said, wait a minute, why do we need these investment advisors? Why do we need all of these people? We can do this all online, and I said, talked to him and said, well, why don't you have an online portal to go in and buy stock at? And, Norm, being the very, very smart man that he was, pretty much said, hey, look, we're selling a service. We're selling the fact that they have somebody to go to in good times to advise them on, hey, you can take a little more risk and or maybe, hey, look, risk, it's getting frothy, maybe take some risk off the table. And then in bad times, when there's been losses, there's somebody you go to and say, well, what do we do? How do we do this? Or, we were getting ready to retire next year. What's our plan? And having that person to bounce those ideas off with years and years and years of experience, there's value there. It's hard for people that typically invest in technology companies. It's hard for them to quantify that, but it's vital. And look how many people pay an Edward Jones advisor or pay a Merrill advisor or pay a Morgan Stanley advisor, 1% a year. For having that person to be able to just bounce ideas off of. And I think the same thing will continue in the real estate space.
Well, that's great. Well, so how best for listeners to get back in touch with you?
Sure. So, we're accessible at tribus.com. You can, if you're in the brokerage business and you want to learn more about the tech side, there's there. But it's also tribus.com. If you go to the bottom of the page, you'll see a VC button, and you can click that. If you're thinking about starting a prop tech company, click that button. And you can learn more about our TRIBUS Capital division, where we would be interested in potentially advising and then investing in your company. So definitely feel free to reach out via that channel, or people can email me. I like I said earlier, the first call is always free. So if you've got a great idea and you want to bounce it off somebody who's been in the space for 20 plus years and has pretty much done every job in the space that's there, including owning a mortgage operation previously, you can feel free to email me. You can get me. Hall, can we put because my name is kind of long, put it in the notes or something like that. It's eric.stegemann@tribus.com. You can catch me there. eric.stegemann @tribus.com. Shoot me an email. If you got a great idea, I will always take the time to jump on a call with you and chat through, and I'll help you try to find any holes. And who knows, maybe it's a fit for us to make an investment in your company.
Great. We'll put that in the show notes. Want to thank you for joining us today and hope to have you back for a follow-up soon.
Sounds good. Thanks so much, Paul.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.